Hello there, guys, and welcome back to Pay Down Debt Solutions. I'm Jen, and today you don't have the big guy, you have me today. I think he'll be in the next video. Sorry, we got a little backed up here, so I decided I'd break velocity banking down for you. As we always, get questions about what exactly is velocity banking, I'm going to break things down for you guys again, and I'm going to, at the end of all this, you see this on the board here, but I'm going to give you examples, and I'm going to show you breakdown examples towards the end of this video so that you guys can see velocity banking in action. So many people wonder what velocity banking is and how to implement it, what it's all about, okay? So what I'm going to do today is kind of go over velocity banking because it is line lending, okay? So we're going to go over velocity banking. We're going to go over the traditional banking method versus the velocity banking concept and why it's different, why this method works for paying down debts faster. And then we're going to go into the elements, the key elements of velocity banking. And then I'm going to show you examples where I break it down. It doesn't matter what level of banking you are at. It doesn't matter what level your income is at. You guys out there, if you're feeling payment poor, if you're feeling stressed, if you're feeling strained and strapped by debt, we all are, no matter what level you're at, right? Whether you make $2,000 a month, $3,000 a month, $5,000 a month, $10,000 a month, $25,000 a month, $30,000 a month, it doesn't matter because so many of you out there, a huge majority of you out there are feeling this way. And that is what led you to this channel. And I'm hoping to bring clarity to you guys every day. Dan is hoping to bring clarity to you guys every day to learn this method, to learn a new way to kick traditional banking to the curb and try something new. So again, my name is Jen. I am a business owner. My husband, Dan, also runs scenarios and videos with me. We are both business owners, okay? So Dan came from the car companies. He is an engineer by trade. He is a math major. I am not. I am not a math major. I'm actually a biomed major, believe it or not. But I found myself in banking, and that is why coming to you today in this setting is very important to me because I am an ex-banker and an ex-branch manager. I did this before I got into owning my own businesses, and all of the tools in the bank make a whole lot of sense to me. So I am the perfect person to bring that to you, right? To talk about it and to talk about what banks do and how they are run and why they operate the way that they do. Their bottom line, right? Everything is by the bottom line with the banks, right? Because they are out for profit, just like you are, right? Any business owner is out to make money. We can't fault them for that. But what I can fault them for is the predatory lending practices, okay? And the amount of interest that they win, that they parasite off of us, right? Because we don't know a different way. They taught us their system. We live in their system, and we're done with that, right? We're done with it because I can teach you guys how to get out of debt faster through velocity banking, through the pay down way, right? The pay down strategy. All right, so let's get into it today. Let's talk about what exactly is velocity banking. So for those of you out there that know what velocity banking is and understand the concepts, but are maybe just a little muddled about how it all comes together, this is a great video for you based on that. And the scenarios that I break down for you, the examples that I'm going to break down later, hopefully will bring you some really good clarity as to why we do this and what it looks like in practical application, okay? So velocity banking is also line lending, okay? So you guys have loans out there, and then there are lines, all right? And they are two very different animals. A loan has an amortization schedule, okay? It's amortized. And a line of credit is not. It's based on simple interest, which is a key element, of velocity banking is simple interest. Now, amortized loans are loans such as your auto loan, your mortgage. Okay, your mortgage is definitely amortized, and also personal loans out there. Many personal loans out there, you're going to see an amortization schedule, okay? Then there is simple interest such as your credit cards, such as your home equity lines of credit, okay? And personal lines of credit. They are done based on simple interest. And the difference between those are simple interest is calculated off of your current balance, okay? It's calculated off of your current balance, and it fluctuates with the balance of that line, okay? So lines of credit can go up and they can go down based on how you use them. And it is that feature that makes them so incredibly beautiful for us who do velocity banking. Now, your loans, on the other hand, are amortized. So what does that mean, Jen? What the heck is that? Well, that means that you have a specific payment that is due every single month when you have a loan, okay? You're given a term, you're given a payment, okay? And those never change. Those are never changing. You are also given interest that you pay, and you have your balance that is paid down out of that payment, okay? So with an amortized loan, those payments are actually designed. Okay, so inside that payment, you're paying interest and you're paying down your principal. Okay, but with amortized loans, your interest that you're going to pay is significantly higher at the very beginning of your loan, and then as you pay your loan off, that comes down. Okay, but that being said, the interest is higher at the beginning of that loan payment, and the amount you're paying towards your balance is low. Okay, very low. So most often you're going to have in an amortized schedule, you're going to have a payment, your first payments, your interest is higher than the amount that you're paying down on that loan, okay? And that is designed in the bank's favor, all right? Because they know, let's take a mortgage, for example, okay? They know that the average person changes their homes between, I think it's 1 and 7 years, okay? So up to 7 years, you're gonna have changes, or they're going to refinance in that time period. And so if they're changing houses, right, and they're getting a new mortgage, after, then that means that the banks want to get all of their interest from you as fast as they can, because they know you're either going to refinance that loan and extend it out again, which actually works in their favor too, or you're going to leave that home and you're going to go somewhere else. And so they can get money from you faster up front this time. And then when you get that new home, they're going to get their money all over again, aren't they? So amortized schedules work in the bank's favor because they're always getting their interest first. So for lending you that money, okay, they're going to get their interest first. And so those loans, okay, you put money into them and you can never take them out, right? You put money in, that money's gone. It is going to, pay that payment, and it's going to allocate that money however it needs to be allocated based on the time that you've been in that loan, okay? Now with simple interest, little different. Simple interest is lines of credit, okay? And so the simple interest is based on that line and how much is on that line, okay? So that can change daily because it's calculated daily, all right? So that feature, okay, of simple interest and the fact that lines of credit are run this way is what helps us, Velocity Bank, and save interest over time, okay? Time is money. We're saving interest over time. So with the line lending, okay, so velocity banking is line lending. They go hand in hand, just as I've explained, okay, because it's that simple interest that helps us out. Now let's talk about why. So with this concept, you bypass the traditional banking methods. And why should this matter? Well, why, okay? Based on the fact that we know loans are calculated and figured for the bank, right, to help the bank win, and lines of credit are also kind of figured for the banks to win, but we can outwit the banks if we run it through velocity banking, okay? So traditional banking, why does this matter? Because traditional banking methods keep you making payments longer, okay? So when you're in that schedule, you're making payments longer, all right? And paying more interest to the banks then, right? But if you are running things with a line of credit and you're doing velocity banking, it's going to be a shorter time frame and you're going to pay off your debts quicker if you run it properly. All right, 2, we all know, and I talk about this all the time, that time is money, okay? Time equals money. More money in your pocket buys you time. Just like here, time leads to money and money leads to time. Money leads to time and time leads to money. Doesn't matter how you run it, right? It doesn't make a difference how you run it. It's all going to be the same. 3, velocity banking uses lines of credit to work down debt through line lending and paycheck parking. Well, how the heck does that work, right? That's interesting. Now, line lending, what does that mean? Well, we are going to paycheck park, right? We're going to take our paycheck and we're going to make a payment to that line of credit. That line of credit then is going to lend us money to pay our bills, okay? It's either going to lend us money to pay our bills and living expenses, or it's going to lend us money to pay our bills and some loans, depending on whether or not we have those loans and lines already inside of that line of credit, okay? And so that depends on which which debt tool you're using, whether they're credit cards or a line of credit, such as a personal line of credit or home equity line of credit, right? So it's going to vary just a little bit there, okay? So let's talk then, seeing as I led into this so nicely, right? The line lending and the paycheck parking. Let's talk about the traditional banking and how traditional banking works. Well, everybody out there has what? When you talk about traditional banking, probably the first thing that comes to your mind is checking and savings accounts, right? Because those are key factors in traditional banking. Those banks need your direct deposit to come into that checking account, and then they want that checking account deposit, and hopefully they can get your savings wherever you have your savings. They're going to try to get that savings from you as well, right? Because the more money that the banks have on deposit with you, whether it's in loans or whether it's in deposits through your checking account and direct deposits, those count to them, even though they seem insignificant maybe to you, right? Because it's your paycheck that's dispersed, and going towards your debts. It's still money coming into the banks at certain times, and it's always filling up their balance sheets, right? So it's really important that they get the direct deposit, and they love direct deposit. So your money in the traditional banking setting is going to come into a checking account. So here's your money coming in. It's going into the checking account, and from the checking account, it's going to pay your debts, right? So it's going to pay your loans, your auto loans, your credit cards, your mortgage, and your bills, right? So it's paying all of these through that checking account. So money comes into that checking account, and then it's divvied up and it's spent out, and then you feel like what? Exhausted, right? Because you're left with nothing. Your bank account is exhausted. It's empty. There's nothing left in it. And you're waiting for the next month to replenish it, to do this all over again, right? All over again, all over again. It's a vicious cycle. And we know that because we live it, right? Especially if we're in debt, man. You live that, you feel it, and you feel like you have no money at the end of the day. And that is what we're trying to solve for you, okay? So velocity banking concept is different, okay? The velocity banking concept is different. We look at the checking account like a pass-through account. It doesn't really matter whether or not we have a checking account that has any money in it, because we're not using it that way anyway, for the most part, okay? So what happens is you have your money that goes into the checking account for about a minute, right? About a second, and it passes through. It's a pass-through account, and it is then parked. All of your income through paycheck parking is parked onto this line of credit. And once it's parked onto that line of credit, a couple things could happen here, right? So number one, we know it's simple interest, all right? And as you paycheck park onto that line of credit or into that line of credit, the first thing that's going to happen is that balance is going to drop, right? So if your line of credit is sitting at $10,000 owed, right? And your income of $5,000 comes in, your $10,000 now drops immediately to $5,000. This interest now is gone, right? There's no interest on the 10 to 5. There is on the 5 though, okay? And so that's what happens. Your interest drops significantly. Therefore, if it's done at an average daily balance, even if you spend more money out of that line, right? You put more onto that line, and the line balance goes back up, it's still done on an average, okay? And that's what's so beautiful about this and how we save money. So you've got your money, you've got your direct deposit, comes into the checking account for about a minute, don't blink or you'll miss it. It goes into that line of credit, you're paying from the line of credit. If your line of credit is holding, right? If it's holding your loans and lines inside of it, it's eating them up, it's holding them. If it's holding them, then all the money that goes into that line is going to pay them down, right? So it's paying down those balances, all right? Paying down those balances. And I can guarantee right here, we're sitting at high interest rates, right? While here with this line of credit, we have one interest rate. We don't deal with multiple high interest rates. We have one, and we're dropping it every month by putting our paycheck in. So you have your line of credit, and you've got loans, your credit cards, and more, and maybe your mortgage. Maybe your mortgage may not be in it, but it could be if it's a first lien home equity, right? So you have all of this inside of your line of credit, and then the line of credit at that point is going to pay any bills or any living expenses that are left over, okay? And so those living expenses and those bills are what bring that balance back up, okay? But again, as soon as you paycheck park onto this line of credit, it's going to drop that balance again. And that simple interest is going to drop again and refigure, right? Recalculate. So we win through paycheck parking, right? Through paycheck parking, you're lowering your monthly interest being charged to you, right? And this is being done again through the simple interest, all right? So simple interest, paycheck parking, line lending are all what velocity banking is about, okay? So if you take the key elements of velocity banking, we're really dealing with three very simple things, okay? And it's not difficult and they all work in harmony. So it's not like you have to remember anything really. As long as you know you're going to be putting your paycheck onto that line of credit and you're going to be paying everything out of it, then you win. And how do you win? Through simple interest. So number one, one of the key elements, right? Using lines of credit the way you were never taught. That is line lending, okay? So you were taught pay your bills, pay your bills, pay your bills, pay all your debts, right? And we're saying pay your debts and then use the money from what you've paid your debts to pay off your living expenses. And then you're going to pay that line again and you're going to pay your living expenses. And then you're going to drop in and pay that line again and pay off your living expenses. So it is very different. But we can all change, can't we? Because without change, right? Without change, we're doing the same thing. We're doing the same thing every day and we're getting nowhere. But making one small change, and that is how you run your banking, can change everything for you in terms of your debt and feeling payment poor. Lord knows, Dan and I felt payment poor. We were strapped. We had so much debt that at one point we contacted a bankruptcy attorney, and thankfully we didn't do it because we found velocity banking, okay? Don't do that, you guys. If you're sitting on the verge of bankruptcy, try this first. Try a new way. Don't go to those predatory companies that want to, help you with your debts, right? Don't do those debt repayment plans because you can do this through velocity banking and save yourself a world of hurt, okay? Number two, right? So number two is paycheck parking. So first was using lines of credit the way they were never taught, that line lending. And two is the paycheck parking, which is putting your income into or onto your line and running all of your expenses out to do what? To drop that simple interest, okay? Which it comes to number three, right? Using simple interest a unique way to drop interest we will pay, right? So simple interest versus the amortized interest, which I talked to you about in the beginning, that is very important because simple interest you can win with when running the velocity way, okay? Now, what we teach is velocity banking through the pay down strategy. And what is the pay down strategy? Again, talk about threes, right? Three very simple steps, okay? Three. One is to organize all of your debts and all of your income. You organize it on a sheet. Every last penny you organize, okay? Once you do that, you are then going to identify two things. One, your debt destroyer, your debt weapon that you're going to use, which is ultimately going to be a line of credit. And two, you're identifying what strategy you're going to use. Do you have a zero balance? Okay, I'm sorry, a zero cash flow. Do you have zero cash flow and you need a strategy for that? Do you have a bunch of credit cards and maybe you need to do a split card strategy, right, to then pay down? Maybe you have a line of credit, a home equity line of credit, and you're going to run everything through that home equity line of credit to drop interest very quickly for you. Maybe you're going to do that, or maybe you're going to use a personal line of credit to do the very same thing, okay? So number two, you're identifying that debt destroyer and you're identifying your strategy, which we help you with. And then three, implementation, how to implement that strategy. It is working your strategy down, which is what I'm going to show you in about a second here when I'm done. I'm going to then list on the board for you a couple different ways to show you whether you have zero cash flow, how you then gain cash flow through velocity banking, or maybe you have a little bit of cash flow. And I'm going to show you a strategy for that and how to use that cash flow to pay down your debts even faster. And then I'm going to also show you what to do when you have a home equity line of credit and you can put everything inside of that home equity line of credit. So hang in with me one second. I'm going to clear the board and I will be right back. All right, and I am back with some numbers for you on how to use velocity banking. And what's really funny to me is as I was writing these numbers out for you and putting the strategies together, I got a call from Rocket Mortgage. And of course, what did they want me to do? They wanted me to refinance my mortgage. And those of you that know us know that we're chunking down our mortgage using lines of credit. But I just find it really funny that during this time they would be calling me. All right, so let's get into the details on these strategies and how they work and how you guys can overcome the interest that you're paying by using Velocity Banking. So in this first scenario here, and these are live student scenarios that I've put together. This last one is a hypothetical based on a home equity, trying to kind of use similar numbers for you so you can see it and it all kind of makes sense, okay? So this is a zero cash flow with a convenience check, okay? So we're running Velocity Banking, we're using the strategy, and we're using a convenience check for 3%. They have a zero balance transfer. Okay, so they have an offer for a zero balance transfer. Now, their income and their total expenses equal each other, right? So there is zero cash flow for this situation. There's no cash flow, okay? And they have, $2,800 approximately is their income. So in looking at their scenario, there's a couple things that we decided to do. And we ended up, there's a couple things that we looked at, I should say, and then what we ended up doing was taking advantage of the convenience check. And this is why, okay? So we take a look at these numbers. Now, these are going to carry through into here, and these I listed for you because they do change some. So we have a rent situation here of $980 a month. We have a car loan for $3,000, and its payment is $420 at an 8% interest rate, which means they will pay back $2,746, okay? Now, credit card one here is at $6,000. The payment on that is $260. It's at a 27% interest rate, and the remainder to pay back is $2,261, okay? They've been paying on this card, and this card was higher. They are paying $260, okay? So they're paying a little bit above and beyond. Many of you don't have the opportunity to do that. They are paying every last penny that they can to try to get this work down faster. So they don't have any cash flow because of that, okay? But they're trying to do the right thing, right? And so we're going to teach them a different way. Now, their personal loan is for $3,200, okay? So $3,200. The payment on that is $350. It's at a 7.75% interest rate, and they will have paid back $2,891 by the time this is all said and done. So what they have is total debt of $12,200. They have a total in loans, okay, just these here, total in loans of $1,030, okay? And whoops, I'm sorry, this does include the rent. So it's not just, these are, let's see, 4, 5, 6, 7. Oh, maybe it is. Hold on, let me add those up for you guys. Sorry, hang on. So we have in loans, I think it is just the loans, 420 plus 260 plus 350 equals, yep, 1030. Okay, so 1030. It is excluding the rent there. So in just loan payments, they have 1,030. So the total that they will pay in interest, okay, right now is $7,898 for $12,200 in debt, okay? That's ridiculous. And this is why we do this, okay? Because this is highway robbery, and this is why there are rules in lending, laws in lending, because again, banks can be predatory, right? Because look at this. You borrowed this much and you're paying almost as much back. It's just sick to me, all right? Now, when we're dealing with credit cards such as we are, there are chargeable expenses and non-chargeable expenses, okay? And the reason being, remember how I said we can put all of our income into lines of credit and we pay our expenses out? Well, if you're working with a credit card, it's a little bit different because you have chargeable expenses that you can charge on a credit card. There are some of your bills you can charge on a credit card. Actually, many of your bills. You can charge groceries, you can charge gas. There's lots of things you can charge on a credit card, but you cannot charge your rent in most cases, your auto loans, and your credit cards, and your personal loans. Those loans cannot be charged through a credit card. So we have to hold them out of our income. So we have to hold them out of our income, and therefore, we have to hold certain things out of our expenses, such as those, because they're not chargeable, right? Those are non-chargeable expenses. So our chargeable expenses in this case is $880, which is our living expenses, all right? Now, our non-chargeable expenses would be $210, okay? So where am I getting the non-chargeable expenses from? Okay, so how do I know, what we can charge and what we can't charge? All right, so if we take our expenses, the $28.90. Okay, so you look at $28.90 and you say, okay, what we're going to do in this case is we're going to take care of all of these charges here by putting them into this credit card that we got for $13,500. All right. And so if we do that, we know that the total is $12,200, but we have a 3% convenience check fee. Okay. And that 3% convenience check fee is going to cost us $366. How do you figure that? You take your 12,200, you multiply by 0.03, and you get 366, which then has to be added to the 12,200 to give us a starting balance of 12,566. Okay. Now, our living expenses are $880 and our non-chargeable expenses. Okay, so non-chargeables. Well, what can't we charge? So we take our total expenses there of $2,890, right? And we subtract out our rent. We subtract out all of these because they're gone now. Okay, so these are all gone, right? So those are gone. So that leaves us with living expenses of $880. Okay, so those are chargeable expenses, and that's what is here. Okay, those are the chargeable expenses. So we then take our income. Okay, so how do we get our income? Well, the usable income, right? The available income, the income that we have available to us is $1,910 because, all right, because you take your income of $28.90, so $28.90, and you subtract out our rent. We've already taken care of this, right? This is now gone, all right? So hold on. All right, so this is gone, right? This is gone, and this is gone because we rolled it into this line of credit, okay? So we rolled it into this 0% card. So we take our total expenses, our total income of $28.90, and we subtract out the rent because remember, that has to be held out into our checking account. You have to leave it in the checking account to pay it that way because it cannot be paid through the credit card, all right? So that rent then has to be held out, so we subtract that out. And then we get our, ready? We get our $1,910. Okay, so that's how we get our $1,910. So now we know what our available income is and we know what our expenses are, and we don't have any interest, do we? Because we're using the 0% card, and it is a 0% card, it was for 12 months, okay? And so we run our strategy. We take our high balance of $12,566, we subtract our income, our available income, and that's $10,556. We have to add back in, though, our expenses, right? Because we're charging those expenses on our credit card each month. We're charging those expenses. So it's $880 is our living expenses, the new expenses that we have, plus 0 for interest because it's at 0% card, which means that our balance then drops to $11,536, okay? So we do our checks here. We started at $12,566. By the end of the month, okay, we're down to when we put our income in, we're down to $10,500 or $656. Then we put our expenses through and we're back up to $11,536. Well, is this higher or lower than what we started from? Well, it's lower, so that means we're moving in the right direction. So this works, okay? You're going to do this every month. You're going to take your available income of $1,910. You're going to take your expenses and they're going to come back in. So we're at the end of month 1, $11,536. We bring our income in, drops us to $96.26. Our expenses have to come back in because we're charging them on that card, and it brings us back to $10,506. We do it all over again. Okay, so how long does this take us? How long does it take this couple to do this? Well, let me reveal that for you. It takes them, 12 months. So ironically enough, it took them 12 months to do this because remember, our 0% only lasted for 12 months. So thankfully it's done in 12 months. And it cost them $366 to do, which is that convenience check. Now, remember, had they run this traditionally, right? They banked traditionally, it would have cost them $7,898 when they got this all done in $366. Velocity banking. Time is money. Time is money. Okay. Now, we're going to take another example here, which we've tweaked, right? I started with this. This was a customer example. Then I tweaked it for you. If we had some cash flow and we did this with a personal line of credit instead of a credit card, how is this different? Well, if that personal line of credit is for $15,000, okay, and it's at a 13% rate, if our income then is $3,200 a month and our total expenses are the same, okay, our total expenses are the same, our cash flow then is $310. Now, we're going to run it and we put all of our debts, so all of these debts, then we absorbed by this line of credit, right? It's a limit is 15,000. We're running it at 13%. And 12,200, right? 12,200 because we don't have any convenience check fee. 12,200, we put our income in. Our entire income can go in because you are running your expenses, okay? You are putting your direct deposit directly into that personal line of credit. It drops the balance from whatever it was, okay? You're putting it into that line of credit, okay? And then it goes ahead and drops your balance from the 12,200 to 9,000, okay? So we then now have in month one, when we put our income in, $9,000 from the 1220, right? So it came in, it helped us out. But we also have expenses now, okay? And our expenses are a little different because remember, we're not holding out anything anymore, right? With these, we got rid of, okay? So they're gone. So now we have our expenses of $28.90, which they were. We subtract out our loan, right? Our rent, because we still have to pay our rent. And we subtracted out our living expenses, right? Our living expenses. So the loan and the living expenses together gives us the 1080, okay? So I'm sorry, the 1030. So that's where we're getting 1030. So you take your 2890, okay, so 2890 minus the 980 minus the 8800 for the living expenses is then your 1030, okay? So that's where we get our monthly expenses. Now, our monthly expenses are 1030, but we have interest this time, don't we? Now the interest comes in. This is that simple interest I was talking about. Our interest rate is at 13%. So we have to figure out what our interest is going to be for 1 month because we know each month when our income comes in, due to simple interest, it's going to drop every month if we are not overspending, which we shouldn't be, okay? So here's what happens. You take your 1220, okay? So we have to figure out, 12,200. We have to take our 12,200, we take our high balance and we take our low balance for the month, okay? And we add them together. And that equals 21.2, okay? But we have to divide that by 2 because we need to get an average of between the two. Remember, simple interest is done at an average daily balance. The closest we can get is to average our high and our low, which leaves us with 10,600, okay? So 10,600. Now, we then have to multiply that 10,600 by 0.13, okay? The 0.13 because we have to move this into a decimal, all right? Now, we get then 1378. That would be for an entire year at that average. But we then have to divide that by 12 because we want only 1 month of that, 1 month, because we know each month that's going to change. So that's where we're getting our $114, okay? Now, this is going to then run continuously. You're going to do this over and over and over again, right? So then you start with 10,144, such as here. Your income comes in, drops you to 69.44. Your expenses come out. Your new figured interest rate, right, between our high and our low, add this, you add this, divide it by 2, multiply by 0.13, and then divide that number by 12 is going to give you 92. And just to prove it, we're going to do 10,144. We're going to add the 69.44. That equals 1798. Divide that. Whoops. Oh, shoot. I divided it by 12. Too soon. All right. So 10,144 plus 6944 equals, divided by 2 equals, apparently I can't type anything. Sorry, guys. 6944. Okay. So our average, we get our average, which is 85.44. Sorry, 85.44. Okay. And then we're going to take that and multiply it by 0.13. And then we're going to divide that by 12, which gives us our 92, as you can see. Okay, so we run this strategy, right? So remember, we still had the same amount in debt. We still had the same amount in debt. What we didn't have is 0%, and we had a 13% personal line of credit. So what happens? So here, and I love the reveal, you guys. This is so much fun for me. I love it. Okay, so we have this now. It's paid off in 5 months versus 12 months, right? Because, all right, we have cash flow that we're working with. It's paid off in 5 months, and it cost us $347 in interest. That's it. That's it. This is the power, again, of velocity banking. This is the power. Now, let's run this one more time. And this time, we're going to do a home equity line of credit strategy where we have a home equity line of credit for $73,000. That's the limit. It is at a 10% interest rate, okay? Their income is $53.90 and their total expenses is $53.90. So we have no cash flow. We are going to give them cash flow, remember? Because when you run these strategies, as you envelop these by that line of credit, it releases these back to you as cash flow, okay? So now we have our mortgage payment instead of a rent payment of $1,280. We have our car payment is $13,000 at a $420. Our credit card is $8,000 at a $260. Our credit card 2 is $12,750 at $350, 19% interest rate, 27% interest rate, 8% interest rate. We have a loan at $29,560 at $509 is the amount monthly they're paying, and that is at a 7.325%. Now, their total in debt, not including the mortgage, by the way, is $63,310. That's a big chunk of change that they owe. That's debt. How do they take care of this debt, and what are they going to do? Now, their payments are $1,539. Okay, so the payments are $1,539. So what we then do, remember, all of these go away because they're being enveloped by this line of credit. So our total amount is going to be the $63,310. So we have to get new expenses. We have to figure out what our expenses. We know we can use all of our income, right? Because we're running it through a line of credit that we can pay everything out of, all right? So we have to take the $553.90, which is our total expenses, and you're subtracting out all of these loan debts, right? The $420, the $260, the $350, and the $509. $420, $260, $350, $509. Now, we still have to pay the mortgage, so that's in our expenses. We still have our living expenses, okay? So our new expenses are $38.51, okay, as opposed to the $53.90. So remember now, the total interest, and I ran out of room because I usually write it to the side. The total interest that they would pay is going to be $26,250 to let this term out the traditional banking way. If they let this go to term, it would cost $26,250. But we're not going to do that, are we? We're going to run the velocity way. So now we take our entire income, the $53.90, and it drops to $57,920. Our expenses come back in. Our interest, remember the high, the low, added together, divided by 2, multiplied by 0.10, then divided by 12 to get our 1 month of interest, which is 505. 505. So 505. And then, so we then go from 57,290, which is the low for the month, and our expenses come out, which leaves us with 62,276. Our income comes back in, 5390. That drops us again to the 56,886. Expenses, interest come back in, and we run this continuously until we are done. Now, you got to do your checks. Remember, is this number, well, I will take this number. Is this number higher or lower than what we started with? It is lower. We're looking good, okay? Now, they then, and this one is a hypothetical, right? So this hypothetical, if it were to term out, okay, with velocity banking this time, all right, with velocity banking, when we finish it, we are going to pay, it's going to be paid off in 47 months. So that's 3.9 years, okay? So 3.9 years, this $63,000 of debt is paid off in that time frame. Think about that. If you double that, that is a house payment of some sort, isn't it? That is what a house costs. If you run it the velocity way, chunking down your mortgage, just think about how much you're going to save. If it cost you 3.9 years to take care of $63,000 in debt, how much time would you save on your mortgage? Side note. Okay, anyway, so they've paid it off in 47 months, 3.9 years. It cost them $13,120 in interest versus the $26,250. So it about halved it now, didn't it? You guys, this is the power of velocity banking. For those of you that are new to our channel, keep watching. We're going to teach you how to get yourself out of debt. We are going to teach you how to free yourself from the chains of debt. And we're going to kick traditional banking to the curb because they're holding us down. We need the banks. We do. We need them. But we don't need them, okay, as much as they need us. We need to make sure that we pay them their interest, but we do it smart and we do it faster, okay? So now you can see you've paid off 12,000. Well, actually, we'll start here. 12,566 in 12 months, and you've spent, and it cost you $366. Here, you've done it with a line of credit. You've paid off 12,200 in 5 months, and it cost you $347. And here, you've paid off $63,310, and it cost you half of what it would have, $13,120. Thank you guys for hanging in with us. If you need extra help, you know where to find us. We are at info@paydowndebtsolutions.com. If you want our worksheets to learn how to work down your own expenses, if you want to see everything written out and you want to organize them, email me. I will send you your worksheets. If you want a little extra and you want us to work it down for you, we can do that for you. All right. Have an awesome day, you guys. I hope you've learned something today, and I will see you in the next video if it's not Dan. Have a good one.